How does a fixed annuity stack up in the battle on taxes in retirement? So in today's video, I'm going to talk about what the tax benefits are for a fixed annuity and why they are benefits for a fixed annuity. By the end of this video, I'll give you the facts so that you have a better understanding about what the tax advantages are for a fixed annuity. Hi, my name is Darlene Hartman. I'm a CPA and founder of D. Hartman Consulting, LLC. For the best retirement annuity advice, subscribe to my YouTube channel and hit that notification bell so that you can receive notices anytime I post a new video. As you've probably heard me mention, one of the annuity benefits is tax deferred growth. So those are some loaded words, but I just want to be crystal clear about this. Tax deferred growth does not mean tax free. As a matter of fact, let's call it tax delayed. So if you have a deferred annuity that cooks or defers for a number of years, can be up to 45 years, depending on what type of deferred annuity you have, you do not pay taxes on the growth during that deferral period. But once you start receiving those guaranteed income benefits, you start paying taxes. Now, if this sounds familiar, it probably is, because a 401k and a traditional IRA are both also tax deferred accounts where you do not pay taxes during the period where it cooks or grows, but rather when you start receiving withdrawals from those accounts. Why is tax deferred growth an annuity benefits if you're eventually going to have to pay taxes on that deferred annuity once you start receiving those guaranteed income paychecks? Well, it would be because of compounding interest. And that is where you earn interest on interest. So I think the best way to explain is to give you an example. So if you have $100,000 and you're earning 5% each year, your first year interest is going to be $5,000. In the second year, you're actually going to compute 5% interest on $105,000. So the interest for the second year is going to be $5,250. And then the next year, your interest will be computed on $110,250, and so on, and so on, and so on. Now, let's say if you have a deferral period of 10 years and it's still a 5% interest rate, the balance after 10 years for your fixed annuity is going to be $163,000. Now, if you had to pay a 15% taxes on that growth each year, your balance after 10 years will only be $152,000, which is a decrease in value of 7%. So now you can see by deferring any and all taxes during that deferral period, that it actually enables your fixed annuity to grow and provide you even more guaranteed benefits once you start receiving those guaranteed income benefits. Tax deferred growth on a multi-year guaranteed annuity during the hold period is actually a huge benefit as compared to a certificate of deposit in a taxable account. So not only does a multi-year guaranteed annuity provide you higher interest rates than a CD over long hold periods, but also the tax deferred growth enables more compounding interest for a multi-year guaranteed annuity than a certificate of deposit, because you have to pay taxes each and every year on a certificate of deposit in a taxable account. So deferred annuities offer an excellent opportunity for compounding interest due to delaying taxes during the deferral period. But as soon as you start receiving those guaranteed income benefits, you do start paying taxes. Leave me a comment in the section below and let me know if it now makes more sense about how compounding interest is actually the benefit from tax deferred growth. Also, if you're enjoying this video, be sure to give me a thumbs up, subscribe to my YouTube channel, and hit the notification bell so that you can receive notices anytime I post a new video. Let's shift gears and talk about a tax advantage deferred annuity. So note that I said advantaged, and again, I did not say tax-free. So even though I knocked it up a notch from deferred, it's still not tax-free. And that would be the qualified longevity annuity contract. So just to give you some quick background information, when you turn 72, the IRS requires you to make required minimum distributions of a certain amount each and every year from your 401k or your traditional IRA. So the QLAC is actually going to provide you a way to mitigate taxes earlier in your retirement. So the way a QLAC works is that you can actually defer the required minimum distribution up to the age of 85 years old, which will again help you mitigate those taxes between the ages of 72 and up to the age of 85. So that's great for compounding interest and giving you even more guaranteed income benefits. But we're talking about the IRS here. So of course there's a QLAC limitation. So the IRS restricts the amount that you can put into a QLAC contract to be the greater of 25% of the total amount in all of your tax deferred accounts, or up to $130,000. But if you've got your tax planning hat on, that actually can be a pretty decent benefit in mitigating taxes early on in your retirement. Are there any retirement products that are tax-free? Well, actually, no. You saw me shaking my head before I even said it. So I don't want to get into too much detail about these two products, but I just want to throw them out there for you. So a Roth IRA, as long as you set it up by the IRS guidelines, will provide you tax-free growth and tax-free withdrawals. But you invest or contribute after-tax money into the Roth IRA. So permanent life insurance, also, if you set it up correctly and maintain it, you do get the opportunity for tax-free growth and tax-free withdrawals. Remember, that's guaranteed income also. So, but again, the premiums that you invest in that permanent life insurance policy is after tax. So again, no, there are no products out there, no investments out there that are 100% tax-free. So I've stated that there are no investments or products that are 100% tax-free. And if you have a retirement annuity, you do defer the taxes during the period where it cooks or defers. But as soon as you start receiving those guaranteed income benefits, you start paying taxes, unless it's in a Roth IRA and it's set up in accordance with the IRS guidelines. And at that point, you do get tax-free growth and tax-free withdrawals. Now, should you put a retirement annuity in a Roth IRA? Well, I'm not sure. It's going to depend on your individual circumstances, but there is more favorable tax treatment if you do put it into a Roth IRA. Now, if you can get more favorable tax benefits and guaranteed income from a permanent life insurance policy, then why do you need a retirement annuity in your retirement portfolio? Well, don't forget about an annuity's superpower. So it's not just the fact that a retirement annuity can provide you guaranteed income, but it can also ensure that you don't outlive your money in retirement if lifetime income. And it costs a lot less than a permanent life insurance policy. So a permanent life insurance policy can be quite expensive, and there are some pretty low cost options for a retirement annuity in your retirement portfolio. So why wouldn't you put 5% into a single premium immediate annuity or another type of fixed annuity to provide you that superpower and ensure that you cannot outlive your money in retirement? Now, if you're interested in obtaining a fixed annuity for the superpower that it can provide you in ensuring that you cannot outlive your money in retirement and providing you that guaranteed income, click the link below to apply to become my client. Also, if you enjoyed this video, be sure to give me a thumbs up, subscribe to my YouTube channel, and share it with your family and friends. Thank you for watching. Let's get the conversation started on how you can live your best retirement while not outliving your money.